So you have been told that you can use your property's equity to build a multi-million-dollar property portfolio without using any of your own cash. Sounds amazing, right? But here is what nobody is telling you. When you extract 200K in equity, you're not getting free money. You're taking on an additional $1,000 per month in loan repayments. And the rental income everyone talks about, lenders only count 75% of it when deciding if you can afford another property. The truth is, most investors hit a brick wall at just 2 or 3 properties, not because they ran out of equity, but because their income can't service the debt anymore. In the next 12 minutes, I am going to show you exactly how the equity strategy actually works, including the real numbers banks use, the monthly costs you will face, and the income you need to make this work without going broke. Stay with me because what I'm about to reveal will save you from making a $200,000 mistake. Hi, I'm Rajan Sharma, and over the past 10 years, I have helped hundreds of Australians build successful property portfolios using strategic equity leverage. But I've also seen countless investors crash and burn because they didn't understand the real mechanics behind this strategy. Whether you're sitting on equity right now wondering if you should pull the trigger or you're planning your first investment, this video will give you the roadmap. Let's get into it. First, let's clear up what equity actually is, because there's a massive difference between total equity and usable equity. Your equity is simply the difference between what your property is worth and what you owe on it. But here's the catch: you can't access all of it. Australian lenders typically allow you to access up to 80% of your property's value minus what you still owe on it. This is your usable equity, and it's the number that actually matters. Let me show you a real example. Your home is valued at 900K. Your mortgage balance is around 500K. 80% of your property's value is 720K. Subtract your existing mortgage, 720K minus 500K, your usable equity is 220K. Now, here is something critical that most investors miss. This 220K isn't free money sitting there waiting for you. The moment you access it, it becomes a loan that you are paying interest on every single month. If you borrow that full 220K at 6% interest on an interest-only loan, you are paying $1,100 per month in interest. That is $13,200 per year, the real loan structure. Now, you might be thinking, okay, but the rental income from my new property will cover those costs, right? Well, yes and no. Let's break down how this actually works. When you extract equity, you typically have 2 options. Option number 1, interest-only loan. Most property investors structure their equity release as interest-only loan for 1 to 5 years. This means you're only paying the interest portion, not paying down any of the principal. Why? Cash flow. It keeps your monthly payments as low as possible while you're building your property portfolio. But here's a reality check. After that interest-only period ends, usually 5 years, your loan reverts to principal and interest, and your repayments can jump up by 40% or more. Option number 2, equity line of credit. This is my preferred structure for most investors. It works like a giant offset account secured against your property. You only pay interest on the amount you have actually drawn down, and you can redraw if you pay extra off. The flexibility there is powerful. You might access 220K in equity, but only draw 180K for your deposit and costs. You're only paying interest on the 180K you have used. Now, let's talk about what this equity actually covers on your next property. If you're buying a 700K investment property, here is how that 180K gets allocated. 20% deposit, which is 140K, stamp duty in NSW approximately around $27,000, legal fees and inspections $3,000 to $5,000, remaining buffer $8,000 to $10,000. You have used your equity to avoid lender's mortgage insurance by putting down 20%, and you have covered all the upfront costs without touching your savings. But remember, you now have $560K mortgage on that investment property, plus you are paying $900 per month on the equity loan you used for the deposit. Let me show you the actual calculations bank used in 2025. your income assessment. Banks look at your gross salary as the primary factor. Let's say you earn 120K per year. That's roughly $10,000 per month gross. For your rental income, banks only count 75 to 80% of it. So, if your property generates $600 per week, that is $2,600 per month, the banks will only assess you for $1,950 to $2,080. Why? Because they factor in vacancies, maintenance, and property management fees. Your liability assessment. This is where it gets brutal. Banks add up all your existing mortgages, personal loans, and car loans, and here's the killer. They assess your credit cards at 3% of the total limit, not what you actually owe. So, if you have a credit card with a $20,000 limit but only owe $2,000, the bank treats it as $600 per month liability. The debt service ratio. Most lenders cap your total debt servicing at 30 to 35% of your gross income. With a 120K salary, that's maximum of $3,500 per month in loan repayments. But wait, there is more. The Serviceability Buffer, APRA. That's the Australian Prudential Regulation Authority. It requires banks to test whether you can still afford your loans if interest rates rise by 3%. So even though your loan might be at 6%, the banks assesses you at 9%. This is called the buffer, and it's designed to protect both you and the lender from rate shocks. Alright, so now you understand the real mechanics. Let's walk through the actual strategy step by step to do this properly in 2025. Step 1. Get multiple valuations. Don't just accept one valuation. Different lenders use different valuation companies, and property values can vary by $50,000 or more between them. Shop around. A higher valuation means more usable equity. Step 2. Audit your serviceability. Before you even think about accessing equity, calculate your true serviceability. List every single debt you have. Pay down or close unused credit cards. That $30,000 combined limit you're not using could be costing you $100K in borrowing capacity. Calculate your net position using banks' actual formulas, including the 3% buffer and the 75% rental income rule. Step 3. Engage a mortgage broker, and not just any broker. You want one who specializes in property investment and understands complex debt structures. They'll help you structure loans to maximize serviceability. Step 4. Research your next market. Here is where your equity strategy meets market strategy. In 2025, you want to target locations with major infrastructure projects underway or planned, vacancy rates under 2%, strong population growth, diverse employment opportunities, good rental yields. Aim for at least 4.5 to 5%. Sydney and Melbourne might offer capital growth, but regional cities like Newcastle, Geelong, and parts of Queensland offer much better cash flow, which improves your serviceability for the next purchase. Step 5. Execute and structure properly. When you access equity, structure it correctly from day one. Open a dedicated offset account against your equity loan. Any cash sitting in there reduces the interest you are paying. Set up your investment property loan as interest only initially to preserve cash flow, with a plan to switch to principal and interest once your income increases or you have sold another asset. Step 6. Build your buffer. This is non-negotiable. You need cash reserves equal to at least 6 months of holding costs for all your properties. Why? Because when interest rates rise or when you hit a vacancy, you need to be able to sustain it without selling in a panic. Step 7. Repeat and scale strategically. Every 12 to 8 months, reassess your equity position and serviceability. As your properties grow in value and your income hopefully increases, new opportunities open up. Now let's talk about the risks, because leverage amplifies everything, your gains and your losses too. Interest rate risk. This is the big one. A 2% rate increase on $1.2 million in total debt costs you an extra $24,000 per year. That's $2,000 per month out of your pocket if rents don't increase proportionally. Between 2022 and 2023, we saw the fastest rate hiking cycle in Australian history. Investors who were maxed out got absolutely crushed. Here is how to manage it. Fix portions of your debt when rates are favorable. Never leverage to your maximum capacity. Ensure you can afford rates at least 2% higher than current. Build that cash buffer I mentioned. Capital gain risk. Properties don't always go up. We saw corrections in 2018 and from 2022 to 2023. If you have extracted 80% equity and your property value drops by 15%, you could be in negative equity territory, owing more than your property is worth. And that's really dangerous. You can't access any more equity. And if you're forced to sell, you're crystallizing a loss. Cash flow risk. This is the silent killer. You might be fine when everything is going well, but one unexpected repair, one rate rise, one job loss, and suddenly you are in a cash flow spiral. Here is the bottom line. Using equity to build a multi-property portfolio in Australia absolutely works, but it requires sophisticated planning, conservative leverage, and a deep understanding of how banks actually assess your borrowing capacities. The investors who succeed with this strategy never max out of their borrowing capacity. Focus on serviceability, not just equity. Build substantial cash buffers. Choose properties with solid rental yields. Work with experienced mortgage brokers and accountants. Plan for rate rises and vacancies. The investors who fail leverage to the maximum. Assume property always goes up. Ignore cash flow. Chase capital growth while bleeding cash monthly. Don't understand bank serviceability calculations. You now know the real mechanics. You understand the monthly costs, the serviceability hurdles, and the risks involved. If you found this valuable, make sure you subscribe to the channel and hit that notification bell, because I'm constantly breaking down complex property investment strategies into actionable steps that actually work in the real Australian market. No fluff, no get-rich-quick schemes, just the real numbers and the strategies that serious investors use to build wealth through property. Drop a comment below and let me know, are you sitting on equity right now? What's holding you back from making your next move? Or if you have already used equity to buy investment properties, share your experience. What surprised you most about this process? I read every comment and I will personally answer your questions. Thanks for watching and I'll see you in the next one.